Let me just briefly follow up your review of global conditions there by adding a little bit more color on what exactly is happening within Japan. The reason Japan's economy isn't doing great at the moment, the two reasons for that. Number one is shown on the left-hand side of this chart here, which is data on real consumption activity from the Bank of Japan. You can see that consumer spending has been pretty stagnant. We've seen barely any growth over the last 3 years or so. Real consumer spending is both below the pre-pandemic level and it's below the level that we saw in 2019 before the consumption tax rate was increased. So it is quite weak. And the main reason for that is that wage growth hasn't kept up with inflation. So that's made households very, very hesitant to spend and kept spending, consumer spending measured in national accounts essentially flat. The other reason why Japan is relatively weak at the moment is the fact that exports have been stuttering. If you look at the right-hand side of this chart here, you see data on Japanese real exports, and they're sitting above pre-pandemic level, but they're not doing too well if you look at more recent history. Particularly in this year, we had a lot of issues with domestic car production. There were hiccups that have held back shipments, and external demand has also been pretty soft. So if you take these two factors together, the fact that both domestic demand and external demand have been pretty weak, that's what motivates our forecast. That's why we think Japan's economy is going to shrink this year. So going back to what I said at the top, 2024 didn't really pan out to be this turning point for Japan's economy. Japan's economy has done a little bit worse than we had expected, even though it's not doing terrible compared to other advanced economies. So now that we've taken stock of where we are, let's take a look at where we're going to go from here. Let's talk a little bit about the outlook. And I want to do that by showing you our GDP forecasts for key economies first. This data here comes from our December baseline forecast, which we only just finalized 2 days or so ago, I want to say. So these numbers are very fresh, and you're some of the first people to see them. I want to start with the advanced economies shown on the left-hand side of the chart. Growth in the US is going to slow next year. Our forecast for 2025 is an expansion of 2.2% in US GDP, followed by 1.6% growth in 2026. Now, that partly reflects the policies that have been announced by President-elect Trump, which we'll talk about more in a moment, but it also reflects a degree of normalization after very, very strong years of growth. Steve talked about this further towards the top. The US economy has done exceptionally well these last couple of years. And in 2024, for example, we're looking for a growth rate of 2.8%, which is very, 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 very solid. Other advanced economies have not done so well. If you look at the UK, Eurozone, and Japan, 2024 was not such a great year. We expect they will all recover in the years ahead, but the pace of that recovery varies quite a bit. In Japan's case, we're looking for growth of 1% in 2025 and then 0.9% in 2026. So that is a welcome recovery, but it is not a rapid one. It is an incomplete one, if you will. The reason for that is that wage growth, we expect that to pick up. But if you consider that wage growth has been virtually flat or negative over the last 2 to 3 years, we don't expect households to come out and rush out to spend, right? We think they will rebuild financial buffers first before they will step up spending. By the same token, even though we expect export growth to pick up a little bit as issues in domestic car production are being resolved, there are just many, many headwinds that are facing exports right now, and those will weigh on growth going forward as well. To that point, have a look at the numbers we're showing here for growth in emerging markets and the world economy, and you will note that we expect growth both in EMs and the world to slow. The group of EMs here includes China, which we expect to grow only 4.2% next year after an estimated 4.9% this year. So Japan's major export markets, China, US, other advanced economies, they're all slowing, and that will weigh on export growth from here on out.
Stefan, can I jump in for just a moment? We're getting a few questions
Absolutely.
already. So let me fire one at you right now. You mentioned a moment ago that 2024 was a bit of a disappointment for Japan, not a turning point. You use those words. But the numbers for the forecast for 25, 26 look better. Will 2025 be a turning point for the Japanese economy?
I suppose it's a matter of definition, right? I mean, I don't want to give you a wishy-washy economist answer and say it depends. But I think the point to keep in mind is that on an average year, Japan grows 1%. So if you have a contraction in 2024, you need to grow 2% the next year to make up that loss. And given that we're only growing 1% next year, I would argue it's perhaps not the turning point that people might be looking for. It's a welcome recovery, but it's an incomplete one. That's how I would frame that. Does that make sense?
Very good. Yeah, thank you.
Cheers. Okay, I'll move on then. Feel free to interrupt me, Steve, if we get any other questions along those lines. I want to talk briefly about how our forecast has changed relative to our November baseline. So the revisions to our forecast, they're presented in this slide here, which shows you how our GDP projections have changed, how much they've changed relative to the November numbers. they've all been revised down, as you can see here, and they've mostly been revised down on account of the fact that Donald Trump was reelected as US president, and he's announced a number of policies that should see growth across the world slow. If we start with the US, shown in green here, we've lowered our forecast by almost 1% if you look at the numbers going from 2028 forward. And that has to do with slower growth in the years before then. So the US is going to see higher tariffs. It's going to see higher, more restrictive immigration policies. We're going to get lower taxes on corporates and high-income individuals, which will lead to higher inflation and lower growth in the US. The primary target of tariffs will be China, which is shown in pink here in this chart. If the US does go ahead and implement higher tariffs on imports coming from China, we believe China would retaliate. And if you get a trade war that would reignite in this sort of fashion, that would damage China because it's an economy that is very, very dependent on global trade. As Steve noted, its strength really in recent years has been exports, and that would be damaged. We think China would respond by deploying some additional fiscal support. We also think that tariffs ultimately would be negotiated down somewhat, which is why you're seeing a little bit of a recovery here in the pink line showing the revisions to Chinese GDP data. But the end result is still negative. So in the long run, the data still settles below where it was in November. Finally, Japan. Japan, shown in blue, will suffer as well. We think Japan won't escape tariffs entirely, especially tariffs on cars. But we think tariffs on Japan will not go up as much as those on other economies. Still, if Japan's two key trading partners, the US and China, if they suffer, Japan will suffer as well, which is why you're seeing a downward revision to our forecasts here as well. Okay, let me move on and talk briefly about the changes in policies that have been forthcoming. So I've explained how the economy is not in great shape, and that comes at a time of domestic political uncertainty. We had a general election this year that saw the ruling Liberal Democratic Party and Komeito coalition lose the majority, and the government is now forced to rely on support from smaller parties to continue to govern. In that context, the Prime Minister Ishiba has announced some additional fiscal support, and additional support for next year is under discussion. So many of the questions we've received ahead of our event today were asking about how should we think about this fiscal support? What will it do to the government's fiscal position, and how will it affect the economy? So let me comment on that in turn. Number one, the fiscal impact, in our view, is not worth losing sleep over. For one thing, the fiscal support is much, much more modest than the headline numbers suggest. But more fundamentally, we need to keep in mind that Japan now sees inflation, and that is new. That is something that Japan hasn't had in 3 decades. If you have inflation, you have higher tax revenue. Inflation also erodes the past accumulated value of stock of debt. So in many ways, the government is the prime benefactor of inflation. So the fiscal support that is being deployed, it's perhaps better to think of that as the government taking its foot off the fiscal brake rather than an outright expansion. So we're not too worried. With regard to the economic impact, things are a little bit more difficult. So the measures that are being announced, they're very focused on strengthening domestic demand. And that is generally the right thing to do when demand is below the supply capacity of the economy. In economic terms, we call that a negative output gap. And the output gap is what we're showing you in this chart here. So whenever the bar in this chart here is pointing downwards, that's the time when you want to provide fiscal support for demand. And you can see that Japan has a long history of very, very weak demand. So that would have been the time to deploy fiscal support. But that was yesterday. If you look at the very right-hand side of the chart, you can see that right now the output gap is basically around 0. So that is to say there's not that much scope for demand-side support. If the government broadly supports demand now, that will probably lead to higher inflation at a time when inflation is already sort of uncomfortably high for many households. So long story short, the fiscal implications of the packages that are being announced, not terribly exciting, but it's perhaps not the right policy, perhaps not the best policy right now. Let me move on then and talk about how all of this will affect monetary policy. As you can see from this chart, we expect interest rates are going to continue to move up. As you can tell from just looking back at the changes over the last 2 years, monetary policy in Japan has changed quite a bit. The BOJ has hiked its short-term overnight policy rate twice this year, and it's also done away with yield curve control, this framework it used to stabilize the long-term interest rate. So all of that is gone now. With regard to the forecast, we expect the BOJ will hike interest rates 2 more times. The forecast right now is for the BOJ to hike again next week. It might be in January, but it's going to be soon. And then we expect another hike in about June or July next year. There's 2 reasons for that. Number one is the BOJ is clearly concerned with the weakness of the yen. The BOJ has hiked interest rates twice this year, even though the economy hasn't done too well. So that reflects that its concern is primarily with the weak yen. It's concerned that the weak yen will bleed into domestic inflation and make life for households and businesses even harder. The second reason is the fiscal support we just talked about. If you get additional fiscal support and you get stronger demand, then that also means you get stronger demand-driven inflation. And regardless of whether that is the right policy or not, it's a tailwind for interest rate hikes. It is another reason why the BOJ could justify an interest rate hike. So that's our view of monetary policy.
So Stefan, if I could jump in with a couple more questions actually related to
Absolutely.
these two charts. These questions are related. One is simply, if the economy is going to perform better in 2025, what is the core driver of that improvement? And a related question is if the fiscal policy isn't exactly the right policy, what would the right policy be?
Great, thank you so much, Steve. Those are both very, very good questions. Let me start with number one. The improvement next year is mostly a normalization after a very poor 2024, right? So we expect domestic demand will do a little bit better as consumption spending finds its footing. So will business spending, by the way. We're looking for CapEx to do a little bit better next year. Also externally, exports should do a little bit better because issues in domestic car production will be resolved. So car exports of machinery, etc., all of that will do a little bit better. But it's mostly, again, a normalization after a very, very poor 2024. So this is not the Japanese economy firing on all cylinders, as you put it for China earlier, right? So this is all, it's all very modest. It's all on very low levels, right? With regard to the fiscal stance, ideally, the government should think about supporting the supply side and the demand side at the same time. Without going too far into the weeds, Japan is experiencing a kind of inflation that is all driven externally by shocks to commodity prices. So investing in the resilience of the economy to these sorts of shocks, that is warranted for the long run as well. So Japan should think of ways to make itself less dependent on imports of energy and food, for example, by investing in decarbonization, clean energy production, etc. That is very important in the long run. In the short run, you can sort of soften the blow, right, by providing support to households, giving them subsidies, lowering their energy bills. But in the long run, you want to think about how to make the entire economy more resilient in order not to deal with that problem in the first place the next time it happens. I hope that makes sense. So supply side support in addition to demand side support would be, if I could have my druthers, right, that's what I would do.
Yeah, thanks, Stefan.
Cheers. So might be a good time then to speak a little bit about inflation and the wage data, since that's so central to our conversation. Let's take a look at the chart on the left here first. This shows you the latest consumer price inflation data for Japan. The headline series is shown in orange, and the bars in the back show you how much different types of goods are contributing to the headline reading. Inflation has been coming down, even though there have been hiccups along the way. Food price inflation and energy inflation have cooled. So again, it's a little bit of movement up and down along the way, but the overall trajectory is clear. What's interesting is that inflation is perhaps a little bit stickier than many had expected. And it's stickier if you compare it to other economies as well. In other economies, inflation rose higher, but then also came down faster. In Japan, it didn't go up quite as much, but now it's also sort of taking its time as it's coming down. And that's partly due to yen weakness. A weak yen raises the domestic cost of imported energy and food, as well as raw materials that go into things like housing, for example. It's also triggered a surge in foreign visitors coming to Japan. So foreign visitor numbers reached a new record, I think, already in October this year, before the entire year was even over. And those foreign visitors, they push up prices for hotels and other recreational services. So basically, all of the inflation you're seeing is all externally driven. Crucially, there is little to no homemade demand-driven inflation. And the reason for that is what you see on the right-hand side here. Real wages have been falling for the better part of 2 to 3 years. So wage growth, even though it has improved, nominal wage growth has not kept up with inflation, which means people's real wages have fallen. And that's what's kept consumers hesitant to spend. You also see how real wage growth is on the verge of turning positive. So that goes to your question earlier, Steve, the one you relate from the audience, right? That's one reason why we expect consumer spending next year to do a little bit better, but there won't be a consumption boom. It will take time. It will be a gradual recovery. Also, there's plenty of risks, of course, facing this outlook, right? If a new trade war disrupts supply chains, causes inflation to reaccelerate, then that would be a new setback. Similarly, fresh yen depreciation might push up inflation, and that would then set us back again. Okay, with that out of the way, let's maybe briefly talk about the outlook for wages next year, because we've gotten a lot of questions about the Shunto wage negotiations next year. So just for those in our audience who might not be familiar with the Shunto, these are annual wage negotiations between labor unions and corporate management, and they're genuinely seen as a bellwether for economy-wide wage growth. Shunto did very well in 2023 and 2024, so the hope is now that that will carry over into 2025. Before I explain the chart, let me just tell you what our outlook is. We do think wage growth will accelerate, but we think looking at the Shunto is probably too narrow. We think the Shunto is probably a little bit overstated. The relevance of the Shunto is probably a little bit overstated. So even if the numbers next year surprise, that won't necessarily change our outlook. Let me tell you why. This chart here shows you some analysis we did this year where we looked into Shunto data going back to the 1960s, and we compared it against economy-wide wage growth to understand how well Shunto results help predict actual rates of wage growth in the economy. The blue data points, they represent the data from the mid-60s to the mid-1990s. So what you see there is, as the Shunto data, which is shown on the right axis, when you get a very strong Shunto result, as that rose, right? It was followed by very, very strong wage growth in the economy, which is shown on the y-axis. In fact, you can basically draw a straight line through the data points here. There's a near perfect one-to-one relationship. So that was true in history, right? In history, when we had a strong Shunto, that was followed by very strong actual wage gains. The green data is the more recent data. It's the data from the mid-1990s up to now. You can see that that data, despite all of the headlines about 3-decade records, the gains are very, very small. They're very, very modest from a longer-term historical perspective. The data is all clustered around zero, as the Shunto results have been much, much more modest, and wage growth overall has also been much, much more modest. What's more, the two don't really seem to correlate very much anymore. Sometimes wage growth goes up a little bit, even though the Shunto doesn't change very much. Sometimes the Shunto changes, but then actual wage growth doesn't change too much. So this is why I was saying earlier, we think the Shunto is probably a little bit overstated as a signal for wage growth to come. So going back to what I said, we won't necessarily change our outlook even if the Shunto data surprises in one direction or the other. There are other broader factors you want to keep in mind when looking at wage growth, like increases to minimum wage, a tightening labor market. The Shunto itself is just not as useful as it once was. Okay, let's then move on and talk about CapEx spending a little bit. That's also been something a lot of you have asked about prior to our event today. You've asked about the prospect for CapEx spending profits, so we thought we would look at that briefly. Let me start with the good news on the left here. The left-hand chart shows you investment intentions, if you will. It's the results from a survey done by the Development Bank of Japan that asks corporates on whether they want to expand in production capacity within Japan, which would be shown in green, or abroad in blue. And just looking at the overall trajectory of the data in recent years, what you can see is that domestic investment is becoming a whole lot more attractive relative to global investment, as unsteady global conditions have clouded the outlook for investment abroad. So that suggests positive investment intentions. The bad news, or maybe not so good news, is shown on the right. The actual CapEx spending is not actually doing as well as you would expect based on those very positive intentions. The data on the right here shows you actual total investment spending in the economy in blue, which is not even at pre-pandemic level. Spending by businesses is shown in green. That is just above pre-pandemic level, but also not very much so, right? It's about 100.2. So in the span of 3 years, it's moved up 2% relative to pre-pandemic level. So that's not as much as we would have expected going back 2 to 3 years. Notably as well, public investment is not doing as well as might be expected. Public investment is shown in teal in this chart here, and you can see that despite the government announcing plans for digitalization, spending on digitalization, decarbonization, social security, defense, that spending has not done too well in recent years. It's much lower than pre-pandemic, and it doesn't seem to be changing. I'll skip over residential investment because that is very small and that's been weighed down by high raw material prices. But the point is basically investment, it's not doing terribly, but it's certainly lacking expectations. And that will have implications for the resilience of the Japanese economy, as well as profit and equities. Today's investment is tomorrow's profit. And if profits suffer, then equities will suffer as well.
Stefan, let me jump in with another question, that came in that actually reflects a question that I have every time I look at this chart, and that is about the public investment, which is very weak. Often in many countries, when the economy is weak, the government jumps in with infrastructure spending or support for consumers, some kind of investment in the economy. And China, I think, is an extreme example of this. It jumps in and starts building roads and airports every time the economy slows, right? Why hasn't public investment been stronger than it has been over the last 2 to 3 years?
Yeah, it's a very good question, Steve. I'm hearing different reasons, and I find some of them more convincing than others. Let me give you a few examples. One is cost. Inflation globally, higher commodity prices globally. They've pushed up the cost of investment because Japan needs to import all of that, right? So as that became more expensive, that made it more difficult to execute on investment spending. Another reason you hear is about difficulty finding workers. I'm a little bit less convinced of that because I think there's still some slack in the labor market, but it's one of the reasons that are being suggested. I think part of it is also just that maybe the government is taking a slightly different view of the matter. One reason that I'm hearing a lot is that the government feels it doesn't need to invest as much because the population is aging. And that makes sense if you think about the countryside depopulating. Maybe it means you need to build fewer roads, maintain fewer bridges. But I think at the same time, you have challenges from a more unsteady global environment, climate change, that raise the case for more investment in the future. So that's another reason that I don't find entirely convincing. I suppose there's a bit of hidden fiscal contraction, but regardless of what the reason is, it does raise questions, because we have all of these big announcements of spending on digitalization, decarbonization, social security, defense, but it doesn't really seem to be happening. So I find this quite puzzling as well.
Very good.
Thank you, Steve. Actually, sticking with the theme of investment spending, let's maybe move on to our risks section. And I want to start by talking about demographics briefly, or actually the growth outlook, the long-term growth outlook for Japan, because we often get questions asking if the low birth rate and the aging of the population will weigh on Japan's growth rate in the medium to long term. And while that's true, in our view, it's actually much more about what's going to happen with this investment spending we just talked about. Let me explain what we did here. This chart here shows you results from so-called growth accounting, which is analysis that tries to understand what is driving growth, long-run growth in an economy. An economy can grow because it has a growing population. So that means you've got more people working, and that is shown in blue here in this chart. So that used to be the case in Japan up until the early 2000s, but now the population is shrinking. So you can see that generates a drag on Japan's growth rate. You can see the blue bars extending into negative territory over our forecast. But you also see that the drag from that is pretty small. So while that matters, it's not the main factor we would pay attention to. In fact, that sort of demographic drag that can be managed. Something Japan has done is it's integrated more women and the elderly better into the workforce, and that then leads to a positive contribution from this green bar here, which shows you participation. So more people working, getting more people into the workforce that haven't worked previously, that helps you offset the drag from a shrinking population, right? And that's one of the ways by which it can be managed. That's happened in Japan. But more crucially, what needs to happen is we need to have more investment spending. That's what goes into the pink bar here, showing you the capital stock. Investment spending has virtually collapsed in Japan since the bursting of the bubble in the bubble economy in the 1990s. And that is really the key reason why Japan's potential growth rate has shifted down so much. So if Japan wants to get serious about ramping up potential growth again, that's what needs to happen. It needs to spend more on investment. That is much more relevant than demographics at the end of the day.
Stefan, this discussion about investment has captured a number of our listeners and there's a
Right.
couple of related questions
Mhm.
about the potential for foreign direct investment. And there's sort of one positive question and one negative question. The positive question is, will China benefit from, will Japan benefit from US-China decoupling? For instance, any trend for new FDI investments in Japan? On the downside is, so what about the environmental issues? There are predictions of major earthquakes to come and such. Would that hinder FDI? Any way you can, I know those are big questions, any way you can summarize?
Yeah, I think these are both great questions. They're difficult, but they do factor into our long-run projections. Maybe long story short, we do think that those are factors that will help investment going forward. Japan is a very attractive location for foreign investors. It's not a traditional sort of location that many foreign investors look towards, but in an increasingly uncertain world, Japan does have one thing going for itself, which is a lot of stability. And now with the yen being incredibly weak as well, that makes it a very attractive location to potentially invest in manufacturing capacity, right? So that is something we think about. Earthquakes, etc., obviously matters a lot, matters especially with regard to the energy conversation, right? It's seen as an impediment to investing in nuclear power. I'm not an expert on that. I think that's probably true to some extent. There's probably also ways to manage that. But I don't think that would be the one reason that should hold up investment in green technologies. There's more that Japan could do to invest in all kinds of green technologies. It's not only about nuclear. So that's how I would think about these sorts of questions. I hope that makes sense, Steve.
Thank you.
Let's actually move on to talk about the yen then, because that's sort of relevant to this entire conversation, right? This is also something many of you have asked about in the questions you've submitted to us prior to the webinar. The yen is still incredibly cheap, and you often ask us why. One reason, obviously, is the gap in interest rates between Japan and the rest of the world. Rates in Japan are very low. Interest rates in the US and other economies are higher. So a lot of people borrow money in Japan, they invest it abroad, they pocket the difference. It's very straightforward. And we can see just from looking at the data and history that seems to be true, because the data overlaps near perfectly. You see in this chart here, the exchange rate, the yen-dollar exchange rate is shown in green, overlaid on top of the US dollar Japan, overlaid on top of the US Japan 10-year bond yield spread. And you can see that they almost match perfectly up until the end of 2023. So we expect that the yen will appreciate as monetary policy converges, as Steve laid out at the top, right? But more interesting is perhaps what happens to the gap that has opened up there. You see at the part where we have this arrow indicating the divergence, that the exchange rate now does not really follow the gap in interest rates anymore, and that tells you that the yen is actually kind of oversold relative to interest rate gaps, which tells you it's all about monetary policy. going by monetary policy and interest rates, the yen right now should be around 135, 140, but instead it's sitting at 152 this morning. So that tells you that some of it is also purely about speculation. The good news is that these sort of things, they don't last. Things that don't make economic sense, they will ultimately disappear. So the yen will recover. It will ultimately settle at a rate that is weaker than where it used to sit in the past. So we're probably not going back to 100 yen per US dollar, but something like 130, 100, 130, 135, maybe that does seem realistic for the medium term. Let me maybe skip the slide here because I see we're coming up on time and head straight over to you, Steve, for the final slide on exports. Over to you.
Sure, Stefan. So this is some data that Stefan and I, and actually a number of our colleagues, have been looking at to, one, track the pattern of so-called decoupling in recent years, decoupling between the US and China, but also looking at the roles that some of the major economies have played in global export markets. And so to illustrate these shifts in the roles of trade, we show a chart on the left, which is 1995, so well before China really moved into the global trade picture. And then 2023, which is the last year of data, last full year that we have for world export trade. In each of these charts, the x-axis shows a trend moving from less advanced to more advanced. That represents the level or value of goods being traded. So more advanced goods would be high value goods, electronics, telecom equipment, things like that. Less advanced goods would be apparel, textiles, toys, plastic goods, things like that. And what we want to illustrate here is the changing role really of China and Japan over this period. So back in 1995, Japan, which is the red or pink line, was focused on sort of the middle to upper level value of goods. In other words, high value goods being exported in the global economy often came from Japan, very similar to the US, and only Germany had a greater concentration of trade in high value goods. Again, this goes way back to trade in automobiles and transportation equipment and other high-tech equipment that came out of Germany back then. And you can see that all of China's trade in the market was all low value goods. In this case, it really was mostly textiles and apparel and such. Fast forward to 2023, of course, there's a long time between these two charts, but the situation has changed a lot. For Japan, Japan no longer really exports in that middle level of value added, but has the highest focus on the more advanced goods. You can see the pink line is fairly low, but then it edges up towards the right-hand side. That illustrates the fact that Japan really does focus more on a narrow band of goods, but higher value goods. And it is about the same as China now. China's trade has moved sort of to the middle upper range, but they dominate nearly every component of the valuation of goods, except for the extremely highest value goods. The super advanced semiconductors would be a perfect example. So the China's that teal line comes down towards the right, illustrating that China dominates most export markets except the very, very high end. And Germany and the US also more focused on the higher end, but not quite. It has a little broader distribution of exports than does Japan across different kinds of goods. All that illustrates that in terms of the global market that, and here again, I'll make one comment here and then pass it back to you, Stefan, if you want to make any final comments, but opportunities in the global export market for Japan based on its industrial structure are kind of limited. I mean, its opportunities are good. In fact, they are high value goods, but there's not a lot of other export goods coming out of Japan at the lower end of the value chain, whereas China has a lot of potential still to move up that value chain and compete with Japan and compete with Germany and the US at the extreme right-hand side of the valuation of export goods. Stefan, I'll let you take it from there. I'm sure there's something more relevant for Japan than what I have mentioned.
No, I thought it was a brilliant summary. Thank you, Steve. I think the reason why so many of us have looked into this data is because it speaks to so many of the issues that we talk about on our webinars, on our podcasts, and our research, right? Which is issues with overcapacity in China, how it's just become incredibly dominant and moved up the value chain at an incredible pace. And that's always something that we struggle with as economists because we love seeing that, right? We're very happy if you see development taking place at that sort of pace. but it does create challenges for manufacturers elsewhere if trade increasingly only flows one way. So that's what makes it such an interesting topic. Thank you for summarizing it.
And one quick detail on this is just a very quick question that came in. Does the China data include Taiwan?
It does not. We have analyzed Taiwan separately in our analysis as well. Taiwan and Korea, by the way, look a little bit like Japan in that they're trying to escape Chinese competitive pressure by sort of escaping to the right-hand side of the chart here by specializing in increasingly higher value-added commodities. But they're both much smaller, so it would sort of make this very busy chart even busier if we had included them here. Very good question. Thank you.